Oh God, that was fun. Right, I think I'm live. I've just been waffling on for the past hour or 40 minutes on my own. Thought I was live and I wasn't. I was talking into a blank canvas basically. So, gives us an opportunity to refine things a little bit, right? So just give it a few seconds. If anyone's joining, have the conversation live, and then we'll dive straight in. What a day today was, eh? What a day today was. What a sell-off. Just see what I can see. If anyone's live at the moment, can you just drop a little note in the chat? Haha, you're here. Good man. Good man. Perfect. So just so you know, I've been on pretty much for the last 25 minutes going over this, talking to a blank screen. I thought I was already live and everyone could everyone could see me. That was just a bit of a shit show, but it does give me a chance to review it and go over it again and get things perfected, let's just say. So, if it's your first time seeing any of this, or you've saw some of my previous videos and you saw some things that you like, maybe you haven't seen anything, so I'm just going to quickly give a quick overview of how I trade, what my strategy is, just some key notes before we get in so that everything kind of sinks in, right? So right now what you're looking at this is yesterday's data, right? Now, because yesterday was what's called Juneteenth, it's a half day because of the holiday. They kind of roll trading days into one. So you see, usually we would have where this kind of ends abruptly, that would have ended abruptly on this session, and we would have had a brand new VWAP band for the session. But basically, because it's rolled 2 days into one, it's an extended version of the VWAP bands. So that's the first thing, just so you're aware. The second thing is the way I trade and what I'm looking for, right? This is balance. I see this purely as balance. And so when prices are balance, I'm not really interested in trading. I don't really like to... I don't like to do too... I think when prices are balanced, it can go anyway, right? It's almost like a liquidity generator for me. So I don't trade where VWAP is balanced. I trade when we are really exhausted, right? And that really extended third standard deviation to the upside or third standard deviation to the outside. I don't trade Asia. What you're looking at right now, if I just extend this slightly. So this is Asia's high. This is Asia's low from the start of Asia's session. I do not trade Asia. I wait to see what Asia's done. I wait for London to open up, and I want to see what's happening with London, okay? And the reason that's important is because usually Asia starts off the session with lower liquidity and consolidates. But as you can see today, Asia absolutely volleyed out the traps, right? And so because it volleyed out the traps, it was really quite an extended move. So what are we waiting for, right? I'm just going to put some key points that I'm looking at when I'm staring at the charts. So 7 a.m. This is what we call the it's like a liquidity injection, right? But it's the kill zone. It's labeled the kill zone, but usually it's when the futures markets open up. They open up an hour earlier than the typical market, right? So UK time, that's 8 o'clock, right? So 8 o'clock, London Stock Exchange opens up. But an hour prior to that is usually when the futures markets open up. So you always get a liquidity injection at that time. Really what I'm waiting for is to see what happens in that zone. I'm really keen to see what happens after 8 o'clock. So this is when liquidity will start to come into the market. This is when London Stock Exchange opens up, and that's when I'm interested to take a trade if we're at third standard deviation. I dial in a lot higher if so. Just to put another kind of thing on the point, because I think that these time zones, they're really, really critical, right, for you to kind of get your head into, is 10 a.m. So at 10 a.m., Asia closes, or Tokyo, and then London continues the trend, right? So London will carry on. I'm not really, ideally, I want to see Asia finish, let that one go to bed, and then see what London does after the fact. However, I'll still absolutely get into a trade if we come into that third standard deviation, but I'm only going to take a trade here. I'm not taking a trade prior to that. I'm not interested in that, okay? So let's just see how price kind of manipulated. Now, last thing before we kick into this, I just thought it was important to really explain this. The other key concept is I didn't trade today, so take everything I say with a pinch of salt, because the psychological element of doing this live can oftentimes become quite different than me just going back in time and saying, here's what I would have done. I might not have done that. Usually I'm trading my system pretty much on point, right? But, you know, psychological elements gets at everyone. And so take it with a pinch of salt. Once we get into a trade, I'm going to try my best to explain this in 3 different formats, right? So I'm assuming everyone who watches this will be some sort of prop firm trader. And that puts you in one of 3 categories. Category 1, you're either trading an evaluation. And if you're trading an evaluation, or the way I trade evaluations is I'm normally full port, which means I'm going maximum contracts and I'm looking for a 10, 15 point move. If I'm trading a PA, right, which is your normal account, until you get over that profit threshold, you can still hit drawdown. Only once you hit your profit threshold will the drawdown stop, and that's the perfect point I'm looking for, right? Ideally, on a 50k account, as an example, once you get above $2,500 or $2,600 to be exact, you no longer get trade and drawdown. And what that means, the really sweet spot about that is once you get over that value, you no longer have to be too nervous about holding on to a trade, worrying that it's going to come back into you and hit your trade and drawdown. However, the opposite side of that is if you do have to be mindful of your trade and drawdown, I'm going to try to explain the 3 ways in which I would approach the trades as we go. So that's all out the way. Sorry about that waffle. I just wanted to really explain that, because if you're new and you don't understand what I'm talking about, it could be a little bit kind of confusing. Okay, so let's hit play. We'll go 10x. Here's our 3 markers. Here's where liquidity starts coming into the market. This will be where London opens up, and this will be where Asia closes. I'm going to stop it when I think it's an interesting point, and then we'll go from there. So you can see right now that Asia is just absolutely, blindingly flying out the blocks. That's probably because we had such a slow day yesterday, right? There was hardly any trading. Okay, so now what's happened is this is where the liquidity comes into the market, right? So this is what's called a London kill zone, or the start of it. It's that hour trade day before, or the hour trade before the London Stock Exchange opens. I'm going to slow it down right now because this is where things get a bit funky for us, right? I'm going to go to 3x. This is where London now opens up. Now I'm interested after this point. If we hit third standard deviation, I'm going to take a trade, right? So let's move on. Oh, live beats. I've just saw that message. I'm so sorry about that. That's painful. Okay, London's opened up. I'm doing this manually now, right? We are waiting. Okay, so now activity's getting serious. We're going to expand this out a little bit. So let's see what happens here, right? Okay, third standard deviation hit. Not quite, but it's close enough. I'm going to hit sell, right? So I've been known to trade between 1 and 3 contracts in the London session, usually because liquidity is relatively low. Today it was really, really high, right? So I probably would have only traded 1 contract, specifically on a PA. So let's hit sell. I'm going to use a $200 stop loss. That's my go-to every time. The rationale behind that is I would absolutely rather get stopped out with a $200 loss and then get back in again. Because number one, it's not a DCA. Don't have to worry about DCA, right? If you're getting stopped out and then you're getting back in, and equally, if it goes against me 3 or 4 times and I'm DCAing in a realistic standpoint, if I keep DCAing and price just keeps going away from me, I'm in a hole, right? And I'm in a spot of bother. If I'm just stopping out for $200 here and $200 there, On a larger accounts, it's paper cuts, right? It's a different way to think about it, but mentally, it's a lot easier to deal with taking small losses. So we're in the trade right now. So let's just see how it plays out. Wicked out. First trade loss. That's fine. Just something to be mindful of here, right? Because this is in replay mode, I'm going to get straight back in again with another sell. But I would have got in here, right, at that third standard deviation. That's where the wick, where the wick went as high as there. Unfortunately, we've got to take the trade here in replay mode, right? Because I don't know if you can see that on the screen. Hopefully you can. But that's the length of the wick there. So we're going to go again. Sell. Okay. $200. So we're already out. We're down 270 because of slippage and whatever else. But we want a $200 stop loss. And now, you know, let's just, again, see how the market goes. This has hit our criteria for entering a trade, right? London sessions opened up. We're at third standard deviation. We're now past, not quite past 10 o'clock. But ideally, you want to see is, this is 10 o'clock. That's when Asia finishes. Let's play it out. Let's just push it on a little bit. Okay, so where's our first interesting touch point, right? So I'm absolutely going to want to bring this to break even. We're in $255 profit. Want to at least just cover. If I'm trading a $50, a 50k account. Now, would I'm looking for 15 points, right? So I would have got in somewhere here in realistic terms. That's where the point is. And so you need 15 points, right? So if I was to go 10 contracts, there's 15 points. That essentially, at 10 contracts, that distance passes you an evaluation, right? And so I don't know how this candle spent its time. Might have went up, might have went down. Don't know. I mean, it's a nice rejection candle, right? That's what you want to see. But that's the kind of thing I want to be doing on evaluations. And so let's, for the purposes of the video, let's assume that passed an evaluation. So we don't need to think about risk management now on evaluations. We're just going to focus on two risk management processes. Risk management process number one is where I have I still suffer with trail and drawdown. So I haven't hit over the threshold, but I still have trail and drawdown. The second methodology is I'm now over my trail and drawdown threshold, and now I'm just trading my normal way. I think what a lot of traders do with prop firms is they focus too much on the 30% consistency rule for good reason, right? You want to try to take as much profits as possible, but equally, I think it kind of, it puts a lot of blockers on the way you trade, and so, you know, let's just see how this plays out. So anyway, right, we're currently in the format of being able to take the trade where I'm worrying about my trade and drawdown. I might want to bring this here. Okay, lock in $80 profit. Let's continue it on a little bit. Okay, so price has come down a little bit more. $340 profit. Remember, we're already $270 down in the whole low, so we've got to be mindful of that. I want to see, that's a nice rejection. Okay, so now here's the reality. You know, $550. I might just take that and not let the trade run. I might just take that because that's $540 isn't bad. And I've got to be nervous if price starts to come against me. I'm now $540 against me in terms of my trade and drawdown. So not talking about evaluations on the PA accounts if I'm not over that threshold. But if I am over that PA threshold, then I'm just going to let this run, right? I'm not in any spot of bother right now. But let's assume in our case, right, we are nervous that we don't want to let it run. So I will bring it down, right? I'm going to lock in $245 profit. Okay, now I'm probably trailing this really aggressively on a normal PA account, right? If I'm not at that threshold, which is candle by candle. But if I was trading this on a normal PA where I was over the threshold, I'm just going to cover myself. So let's just keep it at that, right? But let's assume if I was trading this with a PA account where I was worried about my drawdown, I'm kind of fading this quite swiftly. One other thing to mention, right? Look how far away we are from VWAP, which is balance for the session. The key thing to remember is price always wants to head somewhere for some reason, right? Usually this is the take profit zone. And so you would have absolutely every right to be not too nervous to hold this here right now because we've had a significant rejection. You know what? Typically now, though, even on your PA, that's $615. You would have absolutely no problem taking that profit. That's still a nice profit for the day, right? Let's just rip it forward a little bit more. Okay, as high as $700 profit in terms of that move. But right now we haven't made any kind of comeback structure, right? Everything is just kind of one big move down. So we need to see some structure created so we can reduce our TP a little bit. Okay, we're just kind of creating some liquidity, stuck in a range. That's fine. Not in any bother at all right now. There's nothing making us think we need to be nervous about moving anything at this stage. We are building some liquidity here, so I might be thinking this is a nice shelf that if we break down here to where we can naturally put our TP once we move on. Okay, keeps going down. So remember, if you don't have a PA account here, you're in a good spot because, sorry, if your PA account is already past that threshold, again, remember, once that threshold stops drawing down, now you're just $80 up for the day. That's it. Or you're guaranteed $80 up for the day. If price starts swinging up and down, it's not affecting your drawdown. That's the really key difference here, right? That's why, like, you know, the aim should be get above your threshold and then remove that noise of having to worry about the trade and drawdown. That's the bit what I think a lot of people will focus on. Okay, I'm just going to kind of give us a bit more wiggle room so we can see what's going on the chart. Price is really moving down, so $1,000 in profit, we can absolutely start to bring our TP down. So we'll kind of scale it, we'll kind of bring it down. In fact, I'll probably bring it down to the top of the kill zone for New York. But we want to see some structure created before we drop this down a level. Okay, some news. So look, with $1,700. Remember, this is just one contract, right? One contract that was entered for hitting that third standard deviation in the when London opened up. Not even the futures. It was actual London stock exchange that had opened up. Give us that sweet spot, hit that third standard deviation, and then we were off to the races. Not once has really price came back to scare us at any point. And so we're in a really good spot, right? We're just really letting the market tell us what it wants to do. I'd be slightly nervous here. I'd probably, because we created a double top here, yeah, it's usually a good place for a place for price to come back and sweep. So we're just going to go above that now, unlock in some additional profits, $805 to the top side. Here's where, if you were trading, let's say you had a 50k account, right, and you know, to get a payout on a 50k account, you need to have generated $2,600, right? Once you get over $2,600, like I say, the trail and drawdown stops, right, which is fantastic because then you don't have to worry about that. But if you are taking a trade and let's say you're $700-800 in profit, say here, right, or whatever, and then price starts moving against you, you start getting really nervous then because now, okay, you're still going to be in profit, but because you're only on a $3,000 account, a 50k account, your drawdown's not that great, is it? Do you know what I mean? And so, like, I'm trading this now as if I had a PA that was over the threshold. You know, in realistic sense, like I say, I'm fading this really quickly, and I'm because you don't want to blow an account and you want to give yourself margin. So when you're trading this with a PA with no wiggle room, you just need to be kind of quite tight with your fade of your TP. This is in a different scenario where we're just letting it kind of do its thing, and we'll let the market tell us where we are. But we're in a good spot, right? $1,600 to the good, 805 guaranteed. We're just kind of letting it do its thing, see what else it wants to give us. We have another structural shelf now, so if price comes down again, I'd be anticipating that shelf there. Okay, maybe even bringing it down there to lock in $1,400. I don't think it's a bad idea if I'm completely honest. But we've nearly at $2,000 in terms of that move there. Let's continue on. Oh, beautiful. Right, okay, so $2,700, still have $1,400 locked in. But this is New York. New York's just opened up, and so anything can happen, right, with New York, so we don't want to be too gung-ho by dropping ourselves just yet. But I guess there'd be nothing wrong with just locking 2K in terms of your profit. Let's just keep that there. No, I will keep it just above VWAP in case it wants to come back in. There you go. Could get stopped out, yeah. Okay. So prices really skipped down now, right? I definitely would bring it to there now. That gives us that $1,800, and prices really moving down. Now, here's our conundrum now, right? We're approaching third standard deviation to the downside, which is oftentimes that reversal move. And so, you know, as we start to approach this, absolutely you want to start really thinking about fading your TP quickly, because this is no different from the idea that we want to get into the trades in the opposing side when we hit the top sides of that standard deviation. The only thing that's in my mind is there's previous day low there, right? So this was the previous day low from yesterday, and so that's usually a target where price wants to go and hit. So which is why I'd probably still hold on to this trade, expecting that that's probably going to be a useful target to aim for, right? Craig, just to your answer, I hope I explained that. The mindset shifts completely when you're trading the different styles, right? So if you're trading the account where you are worried about drawdown, I probably would have been, shifting quite quickly. So each time we create a little structure, 2 or 3 candles have dropped, one or two candles come up, then we're moving back down. I'm going to the top of that. So might have got $500-600 out of the trade if I was doing it that way. This way is where you don't have to worry about a drawdown, and you are just letting the market do its thing. And I am going to talk about consistency in a second because I think it's an important topic to cover. Let's continue. So do we take out the previous day? So we've just taken out previous day low. We're at 4,605. Absolutely, I want to lock in some of that profit now, right? I don't want to lose that because of where we are. We probably expect some sort of a reversal. However, I'm just going to kind of keep above where that little move is there, just because it feels there's your pivot point right for the day. It feels like a likely spot that I'm happy to kind of use. No other reason, nothing special, just that it's a pivot point and that's a little bit of a rejection from the first point there. That's the only reason why I'm using that point. Could get stopped out. Okay, stopped out. So $2,700. We got one trade in, we took a loss, and then we got back into the trade, which was here. So in terms of the points, roughly about there. Got out about there. I mean, that was a Hail Mary, right? Not often do you get 174 basis points. That's a really nice move, in my opinion. But what doesn't change is the strategy, right? Each time what you're looking for is, some sort of a move or a run against liquidity. The difference being, right, like a lot of liquidity was already generated in Asia. So if you see, right, just watch this and keep this in your mind, right? If you see, I'm just going to just show you this a second because it's a point, right? Let's say this was Asia. let's say this was Asia's range, right? Kind of, Asia opens up at like whatever, and it's kind of just doing that kind of, move like that. And let's say, that was the high, and that was the low of Asia. Thereabouts. There's Asia's range, right? Opened up. And then what happens then is London opens up, right? Now there's probably not a lot of volume created in the Asian session. And so what price will often do is this is consolidation. What we call what when I say we, I didn't make this up. I just mean what us professionals. I'm not a professional. I'm just joking. What people I hear call it anyway is consolidation, and then oftentimes it will be that manipulation point, right? And that's where it peaks its head above the clouds because for obvious reasons, right? Without trying to teach you guys how to suck eggs, you've got to imagine you've got all this zone here, right? Is sell side stop losses, right? So this is really where all of the stop losses for every time prices come up here and created the high of that range, the stop losses are kind of in this zone, right? And so there's a lot of forced orders that will happen there, which is really what price wants to do, to convert them into a nice big liquidity pot for when the bigger players come into the market. They can trade in them zones where the liquidity is high, right? It's a very standard thing. There's nothing I'm teaching you is like beyond the wit of anyone. Just trying to explain what tends to happen a lot, right? And you see it all the time happening. Asia consolidates, doesn't generate enough liquidity to drive a move forward, so it has to move it out of bound first. And then what it will do is the real move will come up, right, which will be kind of down here. New York will open up, and then it'll kind of end up somewhere back in the range over the course of that day. But what happens, what I've noticed a lot is, so just to bring this forward, because again, just to clarify, when I'm thinking about trading past Asia or before Asia, is all to do with how Asia opens up. So if Asia's consolidated like this, I'm gonna wait until 10 o'clock. That's my time. That's when Asia finishes, and I probably won't take a trade, even if it's at their standard deviation, unless something happens like what happened today, right, where a shit ton of liquidity gets created because Asia just continues to do that, right? So Asia's range was actually more like that. And we'll just show it quickly. That was that was Asia's range there, top, bottom. When you get a range like that, really you don't really need to take liquidity, because all the liquidity is under here, right? There's loads of liquidity right the way up this move because it took a lot to drive price forward. And so the reason, like, if I go back to today's price action, you can see here, look at Asia's range, right? This is where Asia opened up, and it just continued to drive higher and higher and higher. And so by the time we had a little bit of a sell-off at the start of the futures opening up, but then price comes back up, that was the fake move. Really, I'm only taking a trade after 10 o'clock, but because price action was so bullish moving forwards, I thought, well, I don't want to miss out on that opportunity. I'm going to trade the third standard deviation, even in the London session, without Asia needing to close. And of course, that's exactly what happened, right? And it was just a stunning move right the way down. And you only needed that one opportunity. That one opportunity you could have held, even if, so one contract, right? Even if you were on a 3K account, a 50K account, a 150K account, 250K account, a 300K account, whatever account because you were only trading on one contract, that one contract you got in there, even if you, at no point was you underwater significantly enough to suffer your trailing drawdown. So all of these points here where we're hitting these lows, this low, this low, this low, any of them you can take profit on. Right, you don't know which it's going to be, but there was enough opportunities to not have to get too scared and sit on the sidelines and think, I'm going to lock in these profits. It's completely different when you're trading live. I 100% get that. I'm no different. I get nervous and I panic. Where I trade my system best is when I'm not panicking, when I'm past that trading threshold. And so, you know, if you go over the last few video sessions that I've done, and I do this every day, right? Recap on my strategy. I normally don't do it live. I normally just do a pre-recorded session, post it, and then, you know, anyone who wants to watch it can watch it. But even if I don't do it live or I don't post it, I'll do this. If I've not traded the day for whatever reason, I will just go over and say, right, where were the opportunities? What happened? What was the liquidity like in Asia? Was it consolidating? Was it moving to the upside? If it was moving to the upside rapidly, I'm going to get it. I'm happy to get in earlier. If it was consolidating, I'm going to wait until after the market closes, because then I expect a manipulated move, right? Push to the upside, only to send the price back down. So I hope that makes sense. I've had to refine this over years, by the way. This isn't like it's not like there's no blueprint here. It's just stuff you kind of get used to over time. You're staring at the charts day in, day out, looking at price, understanding what kinds of things tend to happen, very pattern based, right? And price action. But I understand two things very well. I understand the erratic behavior of price when it starts to expand too far away or deviate too far away from the mean. And again, you know, why is the VWAP so important? It's because just one sec. Yeah, the VWAP is so important to us, gents, is because the VWAP. This is where, in its truest sense, at any point where the most amount of liquidity is being traded in that day, and for obvious reason, price and, you know, bigger institutions, financial institutions, they want to trade where liquidity is at its highest, right? Because of the price slippage, they want to make sure that liquidity is there. You know, if they're trading where order book's thin, they're gonna not get a well, the orders of magnitude of price that they're moving, they're moving millions right half the time, not like us where, you know, a few contracts here, a few contracts there. They're moving orders of magnitude, and so always price will want to come back into balance. That area where liquidity is at its highest, you know, it's just like an elastic band. I think I've showed this many times before, but nothing quite hits home like this. You know, if you look at this is just statistical data, right? This is, I mean, many of the guys in the server have seen this. I've done this on a few of my videos, but this dotted, this white line here, this is a standard deviation, right? This is the same standard deviation that is set across anything, any statistical model, right? Whether it's someone taking a test, look at a, you know, temperature over the periods of a year. You know, the mean might be in the UK might be 21 degrees, but actually you get outliers. Sometimes it'll be 30, 40 degrees. Sometimes it'll be, you know, -5 degrees. And so the way you think about this is, think of the session, right? Think of the session from the moment the market opens till the moment the market closes. And think of this standard deviation as the amount of time price spends inside of these zones. So if I show you what I mean by this, if I look at here, right? Let me just clear this chart so it's less messy. So if you look, this is that statistical model that I've just showed you. That there is that white line, right? Is VWAP. That's second standard deviation. That's third standard deviation. Well, that's -2 standard deviations. That's -3 standard deviations. This is +2 standard deviations. This is +3 standard deviations. Going back to the chart, there's VWAP in the center. That's -2 standard deviations. That's -3 standard deviations. That's +2 standard deviations and +3 standard deviations. What these percentages represent is the amount of time in a session price will spend in them zones. And so you can quite happily see here, VWAP will spend the majority of its time within one standard deviation from VWAP. And you can just see it here, right? I mean, look at price. Majority of its time it spends in and around this zone, right? kind of hovers in that kind of area. If you look here in terms of between 1 and 2, it's 13% of the time on average, right? It'll spend between 1 and 2 standard deviations, and 13.6% of the time to the plus side of that standard deviation. And, you know, just to kind of look at it again, you can see here, spends an amount of time there in between 2 and 3, little peak, tiny peak above there, you know, moving it here. There's between 2 and 3 standard deviations, and then, you know, a little bit of time between 2 and 3 standard deviations there. And then lastly, you know, the amount of time it spent, and this is why third standard deviation for me is the most important one that I'm waiting for, and I'm happy to sit on the sidelines. How often in a session does price spend above -3 standard deviations? It's 0.1% of the time, and to the opposite side, it's 0.1% of the time. So very, very small time price will spend in them zones, right? Now we've got to remember it's always a moving target, right? So it's never like just wait for third standard deviation. Which is why I'm always waiting for liquidity or something significant to happen, because then the chances of the move returning back becomes all that more higher, because we've done something significant. We've taken a liquidity pool, right? And so back to the charts. I mean, look here. I mean, very little, you know, small movements here above there. There's a little tiny wick there, and pretty much little tiny points here, but very rarely, right? And so that's the strategy, right? It's using data and statistics to kind of give you an edge to say, well, we know price gets erratic. It doesn't like to spend too much of its time above that third standard deviation. That's the key, right? But secondly, what's happened? Is anything significant happened at that third standard deviation to give us the clue that price is going to return back? And that's why for me, I'm waiting for something like liquidity to be taken, whether it's a session high or low. Asia, as an example. You know, if London's closed and then New York takes over, do we take significant liquidity for when the London Stock Exchange closes? And then the third thing is, you know, previous day high, previous day low. These are all really key components that we're looking for. As long as they hit, session liquidity gets ticked, and we're at that third standard deviation, that just really dials in the probability of that reversal for you. So that's the way we trade, and it's been quite a really, it gives you a framework to work to without getting too bogged down with nonsense. Not nonsense, but ICT stuff, right, which has so many different nuances and complexities. It's like, I don't really need to know where there's an order block. I really don't need to know where there's a fair value gap. I don't need to know what a Judas swing is. You know, I just don't. All I need to know is, are we exhausted? Have we taken out some sort of liquidity? Let's get in. What happens if it goes against us? I'll take a loss. It's $200. Get back in. What happens if it goes against us again? I'll take another loss, and then another loss, until there's a point at which I think, okay, this is silly and I need to stop. Or, you know, I've taken enough paper cuts that when the win comes for me, it really goes for me. Like, watch the very first video I did. I've created a playlist, and you'll see I took about 4 losses before it really turns into a really big win, and that's okay. You know, I aim for that. I'm happy with that. Anyway, I've waffled on way too long. Is there any questions? Anyone want to ask anything specific? Anything you disagree with? Anything you like about the system, or maybe you don't? Or if you want to learn some more, you know, make sure you head to the server. Got some fantastic people in the server, really building a solid community. Actually, I'm pretty proud of what we've got there. And also on top of that, we've got other different styles. There's a chap who really knows a lot about order flow, TPO, footprint charts. If that's your thing as well, we've got probably one of the best people I know with that kind of stuff. Everyone's different, right? They have different ways to approach this stuff. Well, yeah, big sell-off today in NASDAQ. Really good. If you capitalized, I put an announcement out. I just tagged a few people in to say, look, if has anyone got in at this area? I just felt like this was a really significant area. turned out to be a beauty, right? Anyway, that's all I think I've got for today. If you're around to... No, I'm not going to be here tomorrow or any time the rest of this week. I'm going camping with the family. So, next session I'll be on is Monday's session, and I'll review it. If you like me to do these live, let me know. I'm always happy to do them live. Otherwise, I'll just do them in the replay mode and send them on. Okay, awesome, lovely. Thank you for chiming in. I will speak to you soon. See you on the next one. Bye.